delighted to be joined again by Stephen Johnson, MD of Shawbrook Bank. And for this short interview, we're going to be talking about repossessions. And Stephen, we can look at both sides of the coin really, because as a bank, you probably have the odd repossession come up where somebody has stopped paying their mortgage and you've got to repossess. So if we start with that side of it, when you are looking to dispose of a repossessed property, what are the issues?
Yeah, I mean, thankfully, they're very rare occurrences. But in the event that that is the case, and a lender has to enforce on its security, the lender has a duty of care to the customer to sort of protect them and ensure that they act swiftly to try and realise the asset and minimise any ongoing liability and interest that might roll up, or arrears fees and stuff like that. So it's very important that the lender moves quite quickly and tries to sort of get kind of the assets sold into the market and get the sort of debt repaid with a minimal of sort of interest roll up. Clearly, selling a kind of a property in possession, the market knows often the condition of the property isn't the greatest, and the market will tend to price in a deeper discount than it was if it was a normal kind of contract and a normal sale. So yeah, I mean, it's buyers are kind of, the market's very sophisticated and it's aware really if a lender's selling in repossession, and typically you'd expect a lower value than if you were selling it yourself, and that's why one of the remedies always for a landlord who is in difficulty is to sell themselves commercially without the pressure of and the market awareness of it being a repossession.
Yeah, we've heard of discounts up to 30% on repossessed property, which seems quite a deep discount in the current buoyant market.
Yeah. A lot of that, I mean, certainly as a lender, we would always anticipate that we would get below market value, probably just from an awareness that it's a repossession, and therefore the buyer sort of factors that in. And but typically in a repossession, you would see a poorer state in the property, and you would see, it wouldn't have the appropriate sort of investment and wear and tear. Sometimes you have malicious damage. So that can sometimes drive the sort of market value declines you see, because the properties have been really poorly treated. I mean, we've evidence of people stripping out plumbing, anything of value. Also, really sort of being malicious in sort of trying to sort of damage the property as much as possible. I mean, there are lenders will tell you stories of concrete in drains and things like that. So, there can be some really sort of quite sort of poor, bad experiences that can come to pass. But that's, I think, sometimes why the values are so much lower on repossession sales, because the overall property condition.
Fantastic. That's very interesting to move on now to if somebody's looking to buy a repossessed property. You've immediately flagged up that intense due diligence is once again key, because there may be additional unseen problems with it.
Yeah, I mean, I think that's absolutely. I think anyone buying a repossession should first ask themselves, why is this a repossessed property in the first place? Sometimes it can be down to borrower hardship, unrelated issues to the quality of the property, but you should start skeptical and really try to be confident that you're aware of why that has failed as an investment. And there can be problems with the tenants. There can be problems actually with the actual title to the property. There can be problems with planning. The client may have tried to sell this and not be able to because it's unmortgageable. So that there may be limited market for buyers, and so just got to sort of ask yourself the thorough question: if I'm being offered what is a really good deal, like all the time, you should always ask yourself, why am I being offered that deal? And is it plausible, and does it make sense? The condition is vital, so make sure you're going out, seeing the property multiple times. Take a surveyor with you. Just be ultra cautious and make sure you do a thorough sort of due diligence. Really, don't get sort of tempted in by a headline discount which you think is incredible. You've got to ask yourself the question about why is that discount there, and make sure you know what you're buying.
Well, concrete in the drain sounds absolutely horrendous.
Yeah.
As a lender, what sort of products do you have to help people take advantage of repossessions?
Sure. So I think there's two things. I mean, the bottom line, I think, is if you're as an investor and you're trying to buy well, whether it be repossessions or other sort of off-market deals, the important thing is your ability to execute and have the confidence of the agent and the sort of seller that you can get the deal done. So you have to have liquidity, you have to be able to transact quickly, and you have to deliver. Otherwise, you'll sort of burn the credibility, and that will limit your future opportunities. So we have a short-term loan product that's geared up to execute super quick, and the whole process is fast. It's not like a mortgage. It's about trying to draw down as quickly as possible. So that product is well suited to having to complete quickly. In addition to that, we sometimes see investors refinancing a wider portfolio, raising the cash, and actually being a cash buyer, so they can, without doubt, execute within 10 days, 14 days, whatever it is that they're using to negotiate on the deal. So actually, you can refinance the rest of your portfolio, raise the cash, use the cash to buy, renovate the property, and then you can refinance the property and sort of effectively kind of release that money that you've kind of taken out. So combination of either buying it direct with a short-term loan, or actually refinancing other parts of your portfolio using the cash, then refinancing the acquired property once it's been renovated in good condition, and probably more likely to be mortgageable in the mainstream market.
Indeed. And do you feel that these kind of deals are more suited to the more experienced investor?
Yeah, I think it comes back to the first point, really. You learn through experience, don't you, I guess? And if you've done a few, you'll probably find some of the pitfalls that you kind of didn't sort of consider maybe first time around. So yeah, I think it lends itself, like all things, to if you've done it a few times and you've had a few sort of lessons, if you like, or things haven't worked out quite what you think, you're probably better positioned to know some more of the risks that exist here. I wouldn't say it's the only. Clearly it's just one opportunity or one strategy that you can follow as a landlord. But my two bits of advice are: make sure you've done your due diligence as thoroughly as you can. This is not something you should do quickly without sort of being drawn in by a discount and not really doing your homework. And then secondly, it's really important that you have the liquidity or the ability to complete quickly, whether that be through a good facility with a bank that is there for you, or whether just refinancing on some other assets so you've got the cash in the bank. They're the two bits of advice I would give.
Brilliant. Well, as always, Stephen, it's great to have your input on these trending topics. Thank you very much to Stephen Johnson of Shawbrook Bank.